Hi folks, this is Sanjana. Today I am here with the easy explanation of revenue, profit and EBITDA. By the end of this video, I am sure you will have a clear understanding of these financial concepts. So let's start with the first one, revenue. Revenue is all the money a business earns by selling its products and services before deducting any expense. Okay, it's simply all the money coming in from its customers. To understand these financial concepts better, in this video we will take example of pizza business. Let's say you sold 2000 pizzas. Per pizza it cost 500 rupees. 2000 into 500, that comes out as 10 lakh. That 10 lakh is your revenue. It's that simple. Okay, moving on to the next one, profit. I think all of you know what is profit. It's the money left over after paying expense. But is it that simple? Most people confuse here. So let's talk about this. For that, first you need to understand what is gross profit. Gross profit considers only the production cost. That means cost involved only in making the product. In our pizza business example, you need cheese, flour, tomatoes, other vegetables and ingredients, right? Let's say all these adds up to 4 lakh. Subtract that 4 lakh from your revenue. You will remain with 6 lakh. That 6 lakh is your gross profit. Why gross profit is important? You are selling your pizza for 500 rupees, and if making every pizza cost 490 rupees, that means something is wrong, right? So gross profit tells us the product itself is profitable or not. Remember, we still not deducted rent, electricity bill, marketing and other administrative cost. All these come under operating expenses. That means cost involved in running the business. Let's say all these operating expenses adds up to 2 lakh. Subtract this 2 lakh from your gross profit. You will remain with 4 lakh. That 4 lakh is your EBITDA. EBITDA stands for earnings before interest, tax, depreciation and amortization. We'll see what all these parameters are. The full form itself says earnings before interest, tax, depreciation and amortization. Interest and tax, all of you know. Interest is something you pay on loan. Tax is something you pay to government, right? Then what is this depreciation and amortization? Depreciation is, suppose you buy a pizza oven for 20,000. Will accounts treat this full 20,000 as this year expense? No. Pizza oven is not only for this year, right? If it is expected to last for 10 years, that 20,000 is spread over those 10 years. That means every year depreciation is 2000. It reflects the wear and tear of assets over time. Then amortization. Amortization is very similar to depreciation, but it applies to intangible assets. For example, patent, software license, trademark and copyright. If your pizza company buys a software license for 10,000 for 5 years, instead of taking that 10,000 as this year expense, that amount is spread over those 5 years. So your amortization is 2000. Now you know tax, depreciation, amortization and interest, right? Subtract those from your EBITDA. The amount you will remain with, that is your net income. That means that is the actual income of the company. Why do investors focus more on EBITDA? Imagine two pizza shops, shop A and shop B. Both shops make excellent pizza. Shop A did not take any loan, so interest is 0. But shop B took a loan, so it is in a position to pay interest. There comes the difference. If you compare net profit of both shops, shop B doesn't look good because it took a loan and paying interest. But if you compare the EBITDA, you will get to know which shop is doing great from its core operations. That is the significance of EBITDA. In the upcoming videos, I'll talk about next important financial concepts. So keep watching the videos. If you found this video helpful, like and comment below what you felt. And don't forget to subscribe the channel. See you in the next one.